The pain of inflation is causing a wide-ranging impact from businesses to individuals. The cost of supplies and the fuel for shipping them can have long-term effects on the economy. I sat down with two experts on the matter, Rea Hederman, Vice President of Policy for the Buckeye Institute, and Guillermo Bervejillo, State Policy Fellow for Policy Matters Ohio. So we're talking about the issue of inflation and the impact that it's had on people all around Ohio. So Ray, let's start with you. What impacts have you seen when it comes to the rate of inflation in the country and here in Ohio?
Well, right now we're starting to see people cutting back a little bit on what they're purchasing. People are purchasing a little bit less in gas. Things that have gotten more expensive, consumers are shifting away from. So instead of maybe sitting there saying, we're going to go out, fill the car up with gas now, they're looking at maybe taking some public transportation. That came out in the numbers. What's happening is people are finding that their paychecks in dollars are not going as far as it used to be. So people are substituting cheaper goods, cheaper brands, in an attempt to kind of continue to live the lifestyle they've grown accustomed to.
Yeah, same kind of thing. I mean, since the child tax credit ran out, the most recent polls I've seen is somewhere near 50% of families are struggling to feed themselves, their kids. One thing that I was reading recently is that people are buying smaller portions of things, like half gallon of milk instead of a full gallon. And the gas thing is critical. Also rent is incredibly high right now, but the gas thing is really impressive. I mean, I don't know about you, but I've actually seen a lot of people stuck on the side of the road because they ran out of gas, probably because they didn't fill their tank all the way. And I know that I've been cutting down on how much I fill my gas tank when the time comes to go to the pump.
So if people are changing their habits because of how much things cost right now, what does that do to the future of inflation? Does that mean that costs will come down if people start changing their habits? And what is the impact of people who change their spending habits? We'll go to Guillermo first.
Sure. It will definitely changing behavior. Will have press down the inflationary pressure for sure. I think that we'll get into this hopefully in this conversation, but I think that the underlying issues here in this inflation situation run much deeper than that. So at this point, it's things can get worse if we don't do something about it soon.
Right?
Yeah, so basically what's happening is, what economists call a drop in demand, and that'll help limit the price increases that we see. If people are buying less stuff, prices are not going to go up as much. What I think, though, the other problem is kind of a little bit like whack-a-mole, and that prices in different areas may continue to elevate. So, for example, Guillermo mentioned, shelter and housing. Housing is about a third of our basket of inflation, and those prices are going to continue to rise. And so, even as people are maybe buying generic brand goods, they're filling up their tanks less, they're shifting to fewer eggs and milk. If housing prices continue to rise, that's going to continue to exacerbate the problems of inflation.
So go ahead, Guillermo.
Ray is right here. Another way that you see what he's talking about is recently we've seen an uptick in the inflationary pressure is reaching services. Yep. And other types of sectors that are not directly dependent on those input goods, those supply chains that are held back. So when you see inflation in services, what that's telling you is that the inflation is cycling through the economy and pressuring other sectors of the economy.
Right.
So let's back up here and take a look at how did we get here to begin with? How did we get to where we are right now with inflation and the problem that we're dealing with right now, Guillermo?
Sure. In my analysis, this situation can be traced back several decades. We have what I would argue are the main things to consider are a trend towards increasing corporate consolidation, as well as increasing financialization of the economy, both of which work together to to reduce the flexibility and the physical capital stock of the country. So what I mean by that is increasingly, and you can see this in many different sectors, hopefully we'll talk about gas in a little bit. Increasingly, what you've seen is a low capital investment ratio for most of these companies, meaning they're investing less in for example, rigs or housing construction, or now we're seeing some investment in semiconductors, manufacturing, that kind of stuff. But for decades, that wasn't the case. So as we invest less in physical capital and the capacity to produce, we're more susceptible to shocks like what we've had recently. The pandemic was, world historic adverse shock, and we don't have the capacity, the flexibility to respond to that shock in any kind of meaningful way.
The long term, I think there's obviously a concern that, are we seeing sectors remain competitive? When you start seeing people shrink and businesses shrink, that can create some long-term problems. But I think the real direct cause, what we're seeing right now in inflation, is from the shock of the pandemic, which has reduced the supply of goods available across the world. So if you take a look at kind of international trade systems where goods have been delayed, coming from everywhere from China to Europe. And so as a consequence, basically when you have fewer goods being produced, you're going to see prices going up because people want to pay more. Then I think you need to combine that with some of our federal policies here in the United States, which were extraordinarily generous under both President Trump and President Biden. So that drove up what we're calling the demand side, where people had a lot more money that they're able to go out and buy these goods. So you had two factors, both pushing inflation up. One is fewer goods were being produced and transported around the world. And then the second thing is people had a lot more money coming in for the first several months of the pandemic, driving up household income. So you had more money chasing fewer goods. And then I think, the Federal Reserve Board kept money very loose. And so a lot of, the bigger businesses, credit and everything was able to expand. So those three factors all have contributed in a very, very short period of time, the inflation.
Obviously, we agree on several points. I think the biggest point of disagreement, which is to be expected, is we have seen, it is true, we saw an increase in demand, especially once the closures started kind of coming down. But at this point, the inflation is hitting us hardest right now, and at this point, people's discretionary funds have disappeared, and we're seeing sky-high credit card, historic levels of credit card debt, and the fact is that, that I agree that is a factor, the increased demand. But in any case, the generosity of that, the impact, the proximate relationship between the generosity of the stimulus bills and the current situation is how it was captured by the financial sector, and not how much it reached our wallets at this point. In fact, the Economic Policy Institute did an analysis of the increase, trying to find the non-financial sectors, breaking down the non-financial sectors' price increases, and they found that 54% of price increases since 2000, from 2020 quarter 2 to 2021 quarter 4, were 54% were accounted for by corporate profits, 38% by non-labor input costs, and only 8% by labor input costs. So it doesn't go quite to the question of the demand, but my point here is that I believe that this is a major supply-driven inflationary shock.
Yeah, I think, the supply is what we're seeing is definitely had a major role. I think the concern that we've seen is that, demand has driven up the spike in goods, and we're starting to see the inflation, leak from the goods to the service sector. And so I think, underlying this remains the fact that a lot of households, you take a look at research by Brookings, other center lefts, a lot of households actually had income go up during the pandemic because the United States had one of the largest bailout packages of any country. That's one of the reasons the United States core inflation outstripped Europe inflation during the first several years of the pandemic, and obviously before the Ukraine invasion. But I think, Guillermo and I are in agreement that a lot of what we're seeing, and I think the part of hopefully the way out, is to increase the supply of a lot of these goods and labor supply of services that can help bring down inflation in the future.
So let's talk about gas prices. That's the thing on a lot of people's minds. Of course, it's having an impact on a lot of people. First of all, when we talk about inflation and then we look at the price at the pump, do those correlate? Is one because of the other? Are we seeing inflation? Are we seeing gas prices higher because of inflation? Right.
Yeah, it's kind of a chicken and egg. I mean, energy prices is about 8% of the goods basket. And so, when gasoline is going up, that's going to drive up the overall price of inflation. And a lot of times, energy and food are so volatile because they go up and down so much. We try to strip those out when we're looking at the underlying inflation measures. But I think at this point, the higher price of gas has become a real contributor and kind of outstripping its role in the CPI basket of goods, because gas is an input now to what so many businesses need. When gas starts getting this expensive, what you're going to see is anybody that's relying on transportation, i.e. basically every business that sells goods, from Target to grocery stores to Walmart, that's going to be driving up their cost of putting those goods on the shelf, because they're going to have to paying so much more to transport those goods, to their endpoint and destination. And that's one of the reasons we saw corporate profits, fall in the last quarter, is because the cost to a lot of these companies of putting goods on the shelves has increased due to the price of gas. And then again, that's going to be an ongoing concern, because energy prices is an intermediate good. It's used to make so many other goods that people use. And so you think about, a lot of people just think about gas as taking their car, getting to school, getting to work, getting to the gym. It's a lot more than that, because so many businesses rely on goods to complete their work product or to be able to deliver their service to the consumer.
So I'm going to give you just a super brief history about why we're here, right? So then we had the fracking boom, right? 2010 to 2014. Tons of money into exploration, production, all over the state, here in Ohio, but all over the country. And what happens in 2015, 2016, right, was that OPEC changed their strategy. They flooded the market with oil. The prices dropped off a cliff, and all that investment that people put into the fracking industry, a lot of people were left broke. So then 2017 to 2020, somewhat of an increase, right? But then again, pandemic shock, and then again, Ukraine shock. So what we've seen is a series of shocks that have affected what I was saying earlier today, the physical capital invested in these sectors. So what you see is the oil sector has reduced their sensitivity to price fluctuations. Prices have gone up, and the oil sector isn't investing directly like they used to, because of the volatility of the market. So what happened once it was clear that gas prices were coming up after the 2020 decline, you started seeing investor calls and in conferences for oil companies of the oil sector. The investors and the investors of the financial sector basically begging the managers of the oil companies to do to discipline capital, to discipline their investment, to hold back on investment, and to capture more profits by keeping the oil in the ground. So they're holding back on investing and building new rigs, because they see this as a means of capturing profit, buying back stocks, increasing the value of what they hold, and benefiting the stockholders rather than the American populace as a whole.
So Guillermo, what we're seeing right now with the higher gas prices, what do you think that means for Ohio when it comes to its future energy policies? Does this send any signal that Ohio needs to diversify in any way, to look at other energy resources?
Absolutely. The problem here, of course, is that the volatility itself doesn't help. The volatility isn't a good economic signal to investors. So actually, I don't think in of itself, it's going to lead to some kind of diversification of energy sources. The answer is obviously yes, we need to diversify. For decades, we've been trying, people have been arguing, I mean, this is decades old, right? That we know that we need to go into renewable energy sources, all those kinds of things. But it's not going to happen just by market signals. We have to make it happen as a society.
Ray?
Yeah, I think what we need is a policy of energy abundance. So diversification is fine. I think what we really need is just more, more of different types, everything from solar, to nuclear, to obviously the fossil fuels industry. Guillermo talked about fracking. I mean, fracking was a great boom because it made Ohio industries a lot more competitive around the world, because all of a sudden one of our main inputs declined in price. So, I think if you look at it from a business perspective, from an oil company or other types of major energy production, they want to take a look at the long run and, and try to escape a little bit of the volatility cycle. And so I think, we need to make sure that we're putting in places policies that can encourage long run investment, and not restrict, basically people who want to produce an energy plant, not telling them they can't do it.
When it comes to inflation and gas prices, there's obviously a lot of finger pointing and it becomes political. When it really comes down to the economic issue of inflation and of gas prices, is it a political issue? Is it something that politicians can fix, or is it bigger than that? I'll let Guillermo go first on that.
Sure, yeah, I think this is clearly political. I think that part of the problem is depending too much on the market for this situation. We could approach it at it from a whole lot of sectors. I mean, part of it has to do with our foreign dependence on oil, and the steps that we've taken against Russia, against Saudi Arabia, Venezuela, Iran. Those are political decisions.
How do we bring on more production to get more supply? Companies are forward looking, and so making big expansion decisions that are costly to recoup is going to require, some thinking, and I'm saying there's going to be a long-term horizon. The tension, I think, in the dichotomy of Guillermo's position is, yes, he says we need more production now, but the same standpoint, we need to transition away from some of these fossil fuel companies. If you're an investor, and you're hearing that coming from the government, that's definitely not going to encourage you to invest long-term if you think that the government may come in and cancel some of your leases or claw back your production in the future. So I think that's a political concern.
What will we see in the next 6 months? Are we going to see things start to taper off, or do we see this continuing?
Well, if I could predict the future like that, I'd be doing a lot. I'd have been out of the stock market entirely. So I think, what you're going to see is, I think the actions of the Federal Reserve Board are going to be key in the short term. How much are they going to be raising rates? That'll basically put some downward pressure, hopefully, on prices. I think, we've learned our lesson a little bit on acting aggressively when you're starting to see inflation numbers this big. I think what to look for in the next 2 to 3 months is going to be inflation month over month. And is inflation shifting more from goods to services, showing up in wages? And they may cause the Fed to continue to raise rates faster, which will drive down consumer spending and really starting to threaten the overall health of the economy.
Guillermo?
Yeah, so definitely not optimistic about the next few months. The Fed is meeting this week. Originally, the expectations were that they would raise interest rates by 0.5%. People are talking about a full 100 basis points right now. Those sound like pretty abstract numbers, but just the math is such that if the interest rates go up a couple percentage points, your 30-year mortgage doubles in price. We're talking a huge impact on people's capacity to have money to pay the things that we need. I think that I'm not optimistic, in part because there is a predominance of this idea that the only response that we have is this heavy-handed Fed blunt instrument kind of response. But the only encouragement perhaps is that Democrats know how dire the things are going to be in November if they don't do something about it. So perhaps that will encourage some kind of courageous action in things like we've been talking about in terms of ensuring long-term investment in key sectors, but also antitrust regulation and making sure that corporations can't capture 50% of the inflationary value.